Alright, welcome to another edition of HNWLifeinsurance.com, hosted by Jason Miracle. This week we're going to look at Equity Index Universal Life and go through some of the different mechanisms that insurance companies use to determine what the ultimate crediting rate of the policy is going to be. You can find us at HNWLifeinsurance.com. Alright. First, what we're going to do is we're going to take a look at an S&P 500 annual point-to-point crediting method. We're going to go into the different crediting methods in a post later next week, but for right now, basically what an annual point-to-point means is if we put the money in today, we're going to track what the indice is at today. In this case, we're using the S&P 500. Let's say it's at 1,000 today, and 365 days or a year from now it goes to 1,200. Well, in that case we would have a 20% return, and that would be your annual point-to-point. What you'll see here is we've built in a policy issue date. All this information is current as of 3/31, March 31st of 2010, and we're going to assume, looking at hindsight, that we put this money in on January 4th of 1990. Couple important points here is we're assuming the policy is going to credit a 1% guaranteed rate, and we're going to have a 13% cap rate, which is the most you can earn on the indice on that point-to-point. So in our example, if the S&P goes from 1,000 to 1,200 over the course of the next year and we have a 20% return, under this scenario, the maximum we could earn within the policy would be 13%, because the cap is the maximum you can earn within the policy. So we'll play with this a little bit and change it around and see what happens. But you'll see back on January 4th of 1990, the S&P was at 355, and the following year, or 1 year later, it was at 321. So we had a loss of 9.75% in the S&P 500 that particular year. Now, since we have a guaranteed rate of 1%, the policy would have credited 1% instead of minus 9 3/4. Now I can change this based on the contract to 0%, and you'll see that it'll show 0. Let's just keep it at 1 for right now and see what that does. So going from year 1 to year 2, you'll see the S&P jumped from 321 to 419 for a 30.6% annual return. Since we have this cap rate, the most we would be able to get is 13%. Now, why is this important? Well, depending on where you're at or what the S&P does, it's going to affect what our return is. Our return isn't necessarily going to be what the S&P actually returns, but what gets returned within the constraints of the Equity Index Universal Life contract. And right now we have those constraints set at a 1% floor and a 13% ceiling. If the return falls in between those two numbers in any given year, then that's the number you will get. So let's take a look at this. If we look at a 20-year historical, the S&P 500 would have averaged 7.58%. This is with the negatives, this is with the positives, this is with everything. If you look at what we would have been credited in a equity index policy, it would have been 7.39. So just a little bit, just slightly off, but very, very close. If you have if you look at the 15-year average, the equity index strategy outperformed the S&P 500 as a whole very minimally. Again, it's much like our 20-year average. But where this gets interesting is over the last 10 and 5-year averages. Over the last 10 years, the S&P 500 has performed negatively by almost half a point. Well, using our equity index strategy, the client would have had approximately 5.7% rate of return. And so again, that's because we have the floor that's helped us minimize our downside risk and capture the upside risk to a degree, or the upside growth to a degree. Now, over the last 5 years, the S&P has averaged 1.14%, but under the equity index strategy, it's averaged 6.7%. So this is a really nice product. Some keys to look out for is policy expenses and things like that. Make sure that you're comfortable with the indice that you use as well as the calculation method. And again, we'll go into the calculation method here in another entry early next week. We hope you enjoyed this. We look forward to hearing from you. Drop us a line, sign up for our newsletter. Again, this has been brought to you by HWLifeinsurance.com. Thank you.